Okay, here we go. Again, thanks all of you for joining us today for this second episode of the Discerning Distributor webcast. Today, I'm joined by a fantastic guest, Joseph Politano. He writes a terrific newsletter called Aprikitas. I came across Joseph on LinkedIn and various other sources of information that I follow, and I always thought his content and analysis was fair, unbiased, and very much driven by data, which I greatly respect. And so I wanted to bring him into the conversation. As you can see, today, our focus is going to be to discuss the macroeconomic landscape, where we are, where we're likely headed, what are the key indicators that we should be paying attention to, and with a particular focus on how distributors should be thinking about costs, whether it's input prices, commodities, anything else that really has a material impact on the bottom line of your business as a portion of your cost structure. How do you see what's happening right now? What does it mean for you as you plan for the rest of this year and into 2023? And really, how should you be thinking about it more medium and long term as well? What are the factors that are going to be affecting input prices moving forward? This episode of the Discerning Distributor is brought by one of our great sponsors, Oracle NetSuite. And I just wanted to share a little bit of information about them before we get started. So for more than 20 years, Oracle NetSuite has helped organizations grow, scale, and adapt to unpredictable change with a unified, true cloud platform. Oracle NetSuite enables fast-growing wholesale distribution companies to achieve operational excellence, manage margins and inventory, and support and expand their geographical footprint for years to come. NetSuite also provides an integrated system that includes financials/ERP, HR management software, CRM, professional services automation, and omni-channel commerce. Most notably, though, it's the NetSuite's demand planning and advanced inventory management that really stands to the forefront. Used by more than 31,000 customers in 217 countries and dependent territories, visit netsuite.com to join our community and evolve your wholesale distribution business with a scalable cloud platform. So thank you again for NetSuite for being a sponsor of today's episode. And now I'd like to invite Joseph to come on, and I can do a quick introduction for him. Joseph Politano is an economic researcher and analyst. He currently writes Aprikitas, an independent data-driven economics newsletter. He specializes in the intersection of finance, macroeconomics, labor economics, and public policy. Previously, Joseph worked as a financial analyst, assisting in the administration of economic surveys across the United States. Before COVID, he worked as an economic development volunteer in Uganda, where he assisted with agribusiness and youth development efforts. Joseph, thank you so much for being here today, and welcome to the show.
Thank you for having me on, Alex, and thanks for all the kind words in this introduction. I'm really happy to be here, and I'm thankful for everyone in the audience. I hope that you're able to learn something, and I hope I'm able to learn something from you.
That's always the goal, Joseph. And with that in mind, I want to encourage audience members to enter your questions using the Q&A button at the bottom of your screen. We'll do our best to address all of them, and hopefully it will create stimulating, engaging conversation for everyone to enjoy and take part in. So Joseph, again, thank you for being here. One of the things that really stood out to me when I saw your content online is, as I mentioned earlier, that you tend to take a very data-driven approach to everything that you write about. So I hope that that's going to be helpful in answering the first question that I have for you, which is, there's a great deal of debate going on right now, whether or not the US economy is in recession, if we're heading for one, what lies ahead. And really, I'm very curious to know that when you look at the economic landscape, what are the factors or what data sets would you consider to be a good gauge of current and future economic conditions? And in particular, with the mind of our audience, who are primarily distributors, are there any ones that you think are particularly interesting to the distribution community?
Yeah, this is a good question, and it's been something that I've written a lot about. I think there's really two ways to think of it. I think normal people tend to think of a recession as like the economy being bad, you know? And then there's like the Poindextery economist way of thinking about a recession, where you're like, well, actually, if you look at these output indicators, you know, it's fine. I think people feel really bad about the economy. And that extends both to consumers and business owners and investors like feel very bad about the economy. On the flip side, that like Poindextery economist side, it isn't feeling as terrible. So for example, like we have these massive price increases, like inflation's running at almost 9% right now. That's like everyone's primary worry. And we've had over the last like 2 quarters negative GDP growth. And so I think a lot of people conclude from that, okay, output's declining, and we've got this massive price hikes because the economy is kind of in tailspin. It's like the classic stagflation line. I think the GDP data kind of oversells how bad things are. And it's really interesting that there's some like the weedsy nuances of how GDP is calculated means it's probably underestimating growth right now. If you look at income, like gross domestic income instead of GDP, that looks good, and if you look at job growth over the last 6 months, it's been really robust, and you'd never have this like it'd be an unprecedented moment in American history if you had a recession in which jobs were added. That's just not how recessions work in this country. There's never been a recession in which jobs were added, and almost all recessions are just defined by the fact that large numbers of people are losing their jobs. Now, I think on the flip side, if you were to look at like the unemployment rate, or if you look at non-farm payrolls, probably overestimates how good the labor market is. It's not like perfect by any stretch of the imagination, but it's clearly not as bad as the GDP numbers. So you're in this like weird moment where, the Poindextery side is saying it's not a recession yet, and I think people's emotions and interpretations of the economy are saying it is. And the flip side is like, okay, well, looking forward, what's the chance of a recession? That those numbers look worse. Those numbers look better than they did like 3 or 4 months ago, where you were saying there's a very high chance of a recession in the next year. Now you're saying maybe there's like a medium-sized chance of a recession. But people have like priced in this slowdown that's, equivalent to like 2016, 2018, where you had like measurable, it wasn't millions of people losing their jobs, like total catastrophe, but you could look and say these businesses were very badly affected. These industries were very badly affected. And I think the part that's very relevant to this audience is like, what does the Federal Reserve want? They're setting interest rates because they want to get inflation under control, and they want to make sure that they don't, cause a recession. They don't want one to happen. They don't want people to have to lose their jobs, or they want to minimize the number of people that lose their jobs. And in their like dream, Jerome Powell, like when he's about to go to sleep, the thing he's dreaming about is a world in which people shift a lot of their spending away from goods. They stop, buying things, and they start buying experiences, local services. They go, get more healthcare, more education, more stuff that's easier to produce in America's economy because of how it was built before the pandemic, and stuff where like supply chain stresses aren't as big of an issue. And so in, that dream world, there basically has to be a pretty big slowdown in consumer sales, in retail sales, in industrial production, in a lot of these metrics. You have supply catches up to demand, but they also want demand for goods to fall down. So some of the indicators, like the forward-looking indicators, I really like looking at credit spreads. I'm a big credit spreads guy. So you're saying like, okay, what do markets think the chances of really risky businesses failing is? That's like a good metric of are financial constraints binding? Can companies borrow money? Do people expect risky companies to go under? And those have been rising. Those are at like 2018 levels. So that was like the kind of mini slowdown that almost was a recession, got the Fed to back off. Job growth, like I said, it's not as rosy as like the headline pictures come up, but it's still good. It's still positive. So that part doesn't worry me that much. Housing growth is really important. Like there's that classic line that housing is the business cycle. And housing growth has been real bad recently. Um, some like fun or like more targeted business to business ones. I like looking at non-defense capital goods. I like looking at heavy truck sales. If you look at truck sales, they almost always precede a recession by like 6 months, and those are falling, but they're not like catastrophically falling. Industrial production is still high. And one of my favorite fun indicators is U-Haul prices. So U-Haul, they'll charge more if you're going from, a city that a lot of people want to leave to a city a lot of people want to go to. When the economy is doing well, people leave Los Angeles, they leave New York, they save up all this money and they go buy a house in like Phoenix or Atlanta. And if you were looking at those, the U-Haul prices, they've been going down too. So that's like a little worrying. If people aren't feeling confident in like, hey, I can move, that's a worrying sign to me.
So there's a tremendous amount of information that you just shared, and I think it's very astute. I wanted to unpack it for just a second. First, I think your point about kind of the term recession in general. When I think that a lot of people, when they hear the word recession, they still think back 2008, 2009. They think about the pandemic-driven recession, Q2 of 2020, right? When things just froze up and we had this falling off of a cliff that happened in the economy. And I think it's important to remind people that a recession could occur without those things happening, right? It could be a much softer, much less severe experience for everyone, which it sounds like what the Fed really wants to initiate, which is they do want a normalization of the record levels of demand that we had during the pandemic for goods. They want a shift in behavior from the consumer, which accounts for 2/3 of the US economy, to buy more services rather than goods. And so the kind of follow-up question I would have based on that is, if I'm a distributor, right, and I'm looking at this potential slowdown in goods consumption, right? Most distributors do add value to their customers, but at the end of the day, they are essentially throughputs from manufacturers to the end users. And so they're providing primarily goods. That could be consumer goods, it could be industrial goods. So when you think about the implications to the distribution sector in particular, are there specific segments that you think are more at risk from this Fed-driven kind of demand destruction, whereas other ones should hold up better? Anything come to mind like that?
Yeah. I think the thought process should be, Matt Klein, who's a writer I really admire, he had this one piece that he called something like, what if the pandemic never ends? And the point wasn't like literally what if COVID is here forever, but it was like, what if the pandemic has induced this permanent shift where people, they spend more time at home, they buy more goods, they consume less services, and the whole, global economy needs to reorient around that. I definitely think there's some part of that you have to keep in your head, that people aren't just going to, like I said, Jerome Powell would love it if people just stopped buying goods, but it's become clear, we're a year plus post vaccinations, we're years past, any lockdowns, that people haven't, gone back and done things the way they did things in 2019. So I'd keep that in mind. The second thing I would keep in mind is like, think of that bullwhip effect, or like that plucking string effect. Like if you were in an industry where demand just went crazy, furniture is like a hypothetical example. Everybody stuck at home, everyone had to buy furniture, everyone had to buy exercise equipment, all of that stuff. Those come back to normal, but now you also have, everyone's already bought the stuff they need for the next 5-10 years. If you bought a kitchen table, you don't need a second kitchen table.
Right.
So people won't.
Right.
And those industries tend to be more credit dependent. People buy these things, with credit cards or, with loans or buy now, pay later, whatever, what have you. That would be where I would worry more.
So you'd almost say like durable goods, things that are
durable
meant
goods,
to last
right?
a long time. Okay.
That's the durable goods, and particularly the kind of durable goods that were like really, saw real consumption rise really dramatically. So cars, are like the prototypical durable good where we didn't make any cars like the last 2 years because of all these supply chain issues. People
Right.
need cars and you have a massive shortage of them. That doesn't go away quickly. But like if you're on the table side of the spectrum, that would be what I would worry about. And the flip side from that is like, think about, what you're competing with for people's money, right? So if gas prices are going up, you're competing with gasoline for people's money. If food prices are going up, you're competing with food. And people can't really cut back that much on food and gasoline. So if you're in that competition, you're very likely going to lose. So, think about what level of necessity are the things that I sell, what level of rate sensitivity or credit sensitivity, do people borrow to buy the things? That those should all be incorporated into what you're doing. And then also just think about like, how if you're in an industry where you're saying, hey, these things are in really high demand, the supply chains have been stretched for years, they've been massive prices, but like nobody's able to buy them because supply chains are so stretched. That might carry the price forward a few years. But if you're in an industry where you're saying, oh, the prices went up a ton because everyone was buying this and we produced thousands or millions more and they were all sold, now you're at a point where you're like, well, who's the market now? You've sold to the whole market.
That makes a lot of sense. So it's clear to me that any distributor that sells really to the consumer as the end market really needs to contemplate those elements that you talked about. How frequently do people buy these things? How much access to credit do they have, and so on. If we were to look on the business to business side of the economy, the more industrial production, non-defense capital goods, a lot of distributors are obviously in that space. And you said a couple of points that I found very interesting. So this idea that trucking is in decline, right? Whereas, we've seen a lot of purchasing online, and we know that there's a shortage of truck drivers, and there's, the rates for trucking were extremely elevated during the pandemic. So I'm curious, why would there be such a big decline? What do you think is driving the decline in trucking, manufacturing, or sales relative to what's going on in the world? And do you think that it's more short-term or kind of a longer-term thing to work out?
It's hard to say precisely. I think trucking is probably falls into one of those industries that's like in the overextended plucking string side of it. Like if you look at people buying a lot more stuff online, but that kind of peaked early pandemic. They're buying less and less online now. Mm-hmm. People are, like I said, they're buying more goods, but that peaked, several quarters ago, and now it's kind of trending downwards. And trucking is also, semi-dependent on other parts of the supply chain. So when you have, really stressed ports, that they're working overtime trying to get things cleared, you have more demand for trucks to be able to clear stuff from the ports and move things around. That stuff has been easing really dramatically. So if you look at Trans-Pacific cargo rates, I was just checking this morning, they dropped 14% last week.
Wow.
Massive declines. And that's the kind of stuff where it's like, okay, the Fed really wants that. But if you're saying the rates on Trans-Pacific shipping are declining, it means demand for Trans-Pacific shipping is declining, because it's not really like you added a bunch more capacity in the last week. And that's worrying if you're a trucking company, because demand can be really fickle. And so, okay, are you really going to, buying a truck is a pretty serious investment. Are you going to go do that right now with everything that's worrying in the economy? And, that depends. It's going to depend on location, on what kind of trucking, short haul or long haul, all that jazz. But you could definitely see how some people are like, maybe this is not the best time. Maybe I'm going to wait a little bit.
Pumping the brakes.
Exactly. That's what people want. That's what the Fed wants to see for inflation a bit. They want to see people go like, is this the best time for me to make this massive purchase? I'm not sure.
Right,
And
right,
the less people that are making those massive purchases, the less, prices go up. And that extends both on the consumer side, where you're like, do I buy this table? Maybe not. But that's also then the trucking company goes, do I need this, extra 18-wheeler? Maybe not.
right, right. Fantastic insight. I have a great question here from Ronald Paulson. He, first of all, commends your points on inflation and supply chain. He wants to know if you have any thoughts on how services is or is going to perform in an inflationary market. How do you correlate products to services? Where are the key areas that customers are going to pull back on, and thoughts on potential impact on distribution? So we've been talking about that a little bit, but I think he's looking for a little bit more insight into what effect services have in this kind of inflationary environment.
This is a good point. So um, if you think about a normal economy, imagine there's no pandemic. There never was a pandemic, right? What's the core driver, I'm putting that in air quotes, of inflation in the US? People's wages increase by a nominal amount, and that drives up, on the one hand, prices for businesses to be able to bid up workers. If you're saying 2%, wages increase 4% a year, 2% of that is just prices. The other 2% of that is productivity, approximation on average, et cetera, et cetera. On the flip side, consumers have more money, they spend more of it. And the things that they tend to spend in proportionate income is stuff like rent, healthcare, educational services. Rent is really the big one. So if you were worried about, like, what if services prices are rising, what does that mean for consumers? I think you're really talking about housing, right? Because if you're saying if healthcare services prices are rising, they're rising dramatically, hypothetically. That's not what we're seeing right now, but like, let's say they're rising dramatically. The only way that can really work long term is if wages for healthcare workers are rising dramatically. And if their wages are rising, then they can afford the same amount of healthcare. You're back where you started. You just, increasing the price level. Your inflation's really high, but
The
it's
wage
not like
inflation spiral, if you will.
exactly. But it's not like they're then going and saying, actually, I'm going to, less healthcare. Rent is the big one, where obviously renting something doesn't need a person to be there. And I think rent is a more concerning one, because the trend for the last decade or so has been rent for low income workers, low income people rising faster than for high income. That's probably good in the sense that, like, if you're selling goods, a good chunk of that goes to higher income people. They're going to be less affected by services inflation. It's bad because people who are low income have a higher marginal propensity to consume. They spend, hand to mouth, or they're more likely to spend hand to mouth. And so if their rent goes up, they got to cut back on something else. There's no ifs, ands, or buts about that. And so that would be the section I worry about, is like, if you're seeing in your area, rents are going up dramatically. People are talking about housing unaffordability. They're struggling to make rent payments. They cut back on everything they can to be able to keep their home. That's like the worrying trend for services prices, in my opinion. And we've seen, I was actually going to say, like, the rent, if you look at rent inflation right now, the official metrics, which they lag what you could sign a lease for today. But the official metrics are saying, like, the fastest pace of rent growth in multiple generations. And also it's something where, like, if rent prices go up, you're stuck paying that for the next year. It can't go back down. And then you say, like, if gas prices go back down, go back to buying, the discretionary things that you can go out to restaurants or whatever. If rent prices are up, that's up for the next year. You got to build that into your budget.
Yeah, it's actually one of the things that I'm looking to with a little bit of hope in terms of sustaining some of the housing market dynamics that we've seen, and not letting it go into a prolonged recession, in the sense that, yes, interest rates are higher, and yes, people are paying more for their mortgages, but at least they're locking those prices in, right? They know what their monthly payment is going to be for the next 30 years. And so I'm hoping that realization, once we have this normalizing of thinking about interest rates at 5 or 6% being relatively benign by historic standards, right? When I bought my first house in 2007, our rate was 7.25%, and the housing market was just fine. Like it wasn't a housing recession at that
Okay,
time.
but you also bought in 2007, so
I know,
maybe not the best example for being
it's
just
not.
fine.
But the point that I wanted to make with that is, I recognize that housing values are in a very different place today. But I think that there's an entire generation of people that are looking at mortgage rates at 5 or 6% and thinking, I've never seen them this high in my entire life, right? But the reality is, obviously, it's still fairly palpable by historic standards, where the mortgage market is, and this idea of locking in a particular payment and then figuring out how to make your personal finances work to that end is something that I look towards with hope in terms of kind of housing market stuff. I do want to change.
Actually,
Oh, sorry, go ahead.
On the housing subject, because this is very interesting to me too. You're in this weird market where like if you think about the spread, it's not really a technical term. It's like, okay, mortgage rates are fixed 30-year mortgage rates at this number, 30-year treasuries are at this number. The gap between those two is like very high by historical standards. And that's because people expect, they expect interest rates, short-term interest rates to be high, this year and a bit of next year, and then come back down as inflation comes back down. And then on the flip side, you have to be worried about if you're trying to price mortgage-backed securities, you're worried about prepayment risk, and you're worried about like interest rate volatility, which are both really high. If you're someone who gets a mortgage today at like 6%, there's a decent chance you could refinance like in 2 years at 4%. And the person issuing the mortgage is aware of this, and they're like, I don't want I don't want you to refinance. So they, the rates go higher, and that spread goes higher. So I think there's also like, hopefully, if interest rate volatility comes down, if the yield curve uninverts, that would, put some more calm into the housing market specifically. The rising mortgage rates are pummeling housing more than you would expect, given the confluence of factors today. But yeah, that's just an interesting point. It's a little unrelated, but I think important. Like I said, housing is a business cycle.
Right. Of course, if I remember correctly, single family housing starts lead the overall economy by something like a year. And so we do want to start to see some improvement in that marketplace as a kind of calming effect on our fears of recession. Last question on the services side. When I look at industrial distributors, again, trying to think about, as they see this potential downside pressure on goods sales. From my experience, there have been some strategies that they could implement by actually focusing on pushing services, things like service contracts, maintenance and repair work for their business, to go out and see at the client side, make sure that the equipment is running correctly. That tends to do better during periods of slower capital goods spending, because companies are trying to make their equipment last longer so they don't have to buy that new expensive piece of machinery. So I think that that's another element that says, yes, there is this risk, but as with all things economic, there's the flip side of the coin. And so you might be facing some downside pressure on goods, but it actually presents a little bit of an opportunity to focus on your service offering and push that forward as an offset for companies, and help them make the equipment they have last longer. Any thoughts on that?
Yeah, I would generally agree with that. And I think what you've seen, from a labor perspective, over the last few years, is you went from a period of, in the mid 2010s, like severe labor surplus, to like a slight labor shortage in like 2019, and now like I think pretty severe labor shortage. That's good, if you're a worker, and that's good for the general economy, that people are getting paid more, and productivity growth is higher. But what it also means, for you as a business, for your opportunity, is that if you have a productivity edge in labor, that's more valuable now. And so if you're able to, allow your workers to be more productive than the competition, that's going to be more valuable than it was in 2015, when like being able to have a more productive workforce wasn't as big a competitive edge, because wages were so low, wage growth was so low. So yeah, if you're in that position where you're saying, hey, I know my team, I know my company And these are the things that I've done to make them more productive during the pandemic, during the lot crazy last few years we've had. That could be a serious competitive edge.
Yeah, and it actually goes really well in hand with a question that just came in from Dmitry Kmel. He asks, do you expect any trend to increase productivity through more automation, digitization of industry, or other innovations? Any thoughts on that?
Yeah, I think, when you have the high demand economy, especially high labor demand, functionally, there's a fixed rate of worker growth. In the US, it's not like suddenly you're going to have millions of people immigrating. It's not like suddenly you're going to have millions of people becoming, turning 18, or that you're somehow going to get all these people who retired all back in the workforce at the same time. So when there's like these severe labor shortages, the answer is usually people invest in making the workers they have more productive. And you've seen that in a big way with a lot of pushes by companies in the service sector, like, okay, we're going to, now everyone's working from home. Here's how we're going to automate processes. Here's how we're going to cut back on costs. And I think you've seen that with a lot of labor in like the warehousing and transportation sector that's gotten a lot more efficient, even as that sector has chewed up a bigger share of the US's total labor pool. And so I fully expect, you see that whenever there's a labor shortage, companies find ways to get the best out of the workers they have. And usually that's good for, workers, for the average economy too, because that productivity growth trickles down into real wage growth, trickles down into, bigger investment. So I am bullish on that. The one thing I would say is like, when the Fed's raising rates, what they kind of want, in the most abstract sense, is they want companies to kind of be colder towards that idea. They want them to say, okay, maybe I shouldn't hire this worker because I don't know what's going to happen in 6 months. Maybe I shouldn't invest in this because I don't know what's going to happen in a few months. And that's going to pull down, overall demand, which is really necessary right now to get inflation down. But it's also, they would want to see the labor shortage weaken. They would love if that came from higher labor supply, if the workers who left during the pandemic come back, or if people who weren't in the workforce, because of various reasons join. But I think they fear that it's like going to have to come partially from reduced labor demand, which is also going to mean reduced demand for like, automating processes, fixed investment, productivity investment, things like that.
Yeah, I would second many of the things that you touched on. We're not likely to solve our immigration policy woes in the near term. We're not likely to see our birth rates tick up magically all of a sudden and generate this new big workforce of the future. So these are issues that are not just short term, but they're more medium and long term in nature as well. And I think that after this blip of a Fed-induced, let's take a breath and catch up a little bit collectively with what we've just experienced over the last 2 years, I think that a lot of investment will have to flow into things like automation and doing more with less, if you will, in the reality of the economy that we have going on right now. I do want to make sure that we have time to address the inflation element, and there's no better way of doing that, I think, other than talking about kind of input prices for all sorts of things that businesses and particularly distributors have to contend to. So let's shift gears a little bit and talk about commodities for a bit. Obviously, you mentioned gasoline prices earlier. We've seen that surge when the national average briefly topped $5 a gallon. We've now seen a significant pullback. And based on what I'm seeing out of refineries, that downside pressure on gasoline should persist, at least in the foreseeable future, because they're incentivized to produce more of the other non-gasoline stuff like jet fuel, like diesel, heating oil, that is actually, the inventories of that are suppressed still relative to pre-pandemic levels. So that's been an interesting dynamic to watch. What can you tell us from what you're observing in the commodity markets, particularly when you think about oil and gas or energy costs in general?
Yeah, I think it's been a crazy like 6 months. I don't know how religiously you follow markets or your audience does, but it's wild to like wake up in the morning, you're like, oh, crude's down 10%, whatever.
Right.
Like
Right.
moves that would be chaotic, cataclysmic events in like 2019. You're like, yeah, whatever. But we really have seen crazy developments, and the U.S. is in a lucky position. But I actually don't want to put it as luck, because it's a fortunate position that was partly luck, partly planning, compared to economies in Europe and other economies in the high income nations that are much more reliant on energy imports. I'm thinking like Japan, Korea, Taiwan, because we have like much better domestic supply, and we're not reliant on natural gas connections from Russia in particular.
Right.
So when you had the invasion of Ukraine, you saw this, like, you already were in a very tough market where oil and gas prices were significantly higher than they were before the pandemic. Companies were a little reluctant to invest because you had that price war between Saudi Arabia and Russia in the beginning of the pandemic. And they had also lost, I think if you total up the profits of US shale over the last decade, it's like negative 600 billion. It's a crazy number of money they lost. So they were like, all right, we're not doing this again. We're going to make money this time, we promise. And so you saw oil prices keep rising and rising and rising. And then you had the impetus shock from the Russian invasion of Ukraine, which sent oil prices rising, and it sent gas prices skyrocketing because American and global refineries rely on Russian feedstock, and they rely on Russian refining capacity that basically was wiped off the map by sanctions. The good news is two parts. The first is that, like, for gas in particular, we've really shaken off the refinery shortage. So you look at spreads between oil and gas; those come back down to like high, a level that, like, again in 2019 you were like, this is chaotic, but now you're like, yeah, it's fine. Much lower. So at the peak, gas spreads were like 50 a barrel. Now it's closer to 15, 20 a barrel, which is about normal range, high end of normal range is how I would put it.
And can you give a little bit of a background in terms of the spreads that you're talking about? What is the spread between?
Yeah, well, if you think about it, a refinery's job is to convert, and I'm really simplifying, but like a refinery's job is to convert crude oil into gasoline. They charge a cost for that. The spread is supposed to be a representation of that cost. Or if you want to put it another way, it's like the profit to the refining company. If a spread is really high, you're expecting more refinery capacity to come online. That takes a lot of time. If it's very low, you're basically saying, okay, well, refineries, they have plenty of capacity. It's really easy for them to convert, so they're charging low prices. It's a supply-demand relationship. You reached a point in middle of this year, in like June, July, where it's like there was no capacity. The only place on planet Earth that there was capacity was in China, and China was experiencing these massive lockdowns, so they were not trying to refine anything at this point. That has abated. So you look at those, you're saying, okay, the demand, the supply caught up. You were able to basically make your way through backlogs of refined goods, and the demand came down a bit. So you're at a point now where you're like, we're okay. The refinery spreads are back down to normal. We're not in like this critical, acute global refinery shortage.
Right.
On the flip side, like the oil has also come down pretty significantly. In my opinion, that has much, much more to do with the really big slowdown in China than it has with like anything that happened in the US, except for maybe the release from the Strategic Petroleum Reserve. That is really hard to forecast. So I think you're in this moment where energy markets are really fragile. If you had, if gas shortages in Europe got worse, you would see more substitution with oil and with other fuels, with coal, things like that. If China beats COVID, or they abandon COVID zero or whatever, the economy reopens, putting in air quotes, and their gasoline demand goes up significantly, that could, push markets to the brink. And you're at a point where like the Saudis and OPEC Plus agreed to a like symbolic production cutback this month. It really wasn't material in the sense that it's a very small number, but it was like symbolic of them saying, we think it's oversupply. We think actually oil prices should go back up a little bit. And so that's like, I think very worrying moment. And I think, like I said, those 10% moves are not normal. That's not how oil markets normally operate. And so that would be a worrying trend. I think we're in a good place now. And if you look at futures for like the next couple months, people expect to stay in a good place, prices to come down even a little bit more, but that there's still this underlying fragility where if the geopolitical landscape changes, you could see, big rises in gas prices again.
Yeah, and I think, sorry, go ahead.
Oh, I was going to say, and the Strategic Petroleum Reserve, it's a lot, it's not infinite.
Right.
And so it's not like they're running out, but they've used a decent chunk of it at this point. And so at some point, it obviously this is what it was made for. The reason gas prices were up is because of a war, and it's a Strategic Petroleum Reserve. It was literally created because they were scared of war with the Soviet Union and OPEC stuff. So this is what it was built for, but also it's not like an unlimited resource.
Yeah. So when you think about all of that, a lot of the things that have been driving prices are seemingly outside of the macro landscape, right? It's the COVID shutdowns in China, it's the war in Ukraine, it's things that are, perhaps you can call them, the black swans, right? Of what could potentially happen. If I were to just look at the economic impetus of what's going on based on our previous conversation, and try to say, all right, in the face of a slowing economy, what do energy, oil, natural gas prices tend to do? How would you answer that?
I would say it usually, you're not going to see big effects, because the energy and oil markets kind of run independent, and like you have OPEC trying to usually acts as this counterbalancing force, where if they say, hey, we expect the economy to decline precipitously, they're going to say we're cutting back. And OPEC has, they don't have infinite discretion on how much they can supply, but they have a lot more discretion than basically anybody else. And right. So if they decide we think there's a slowdown, we're going to cut back, that'll keep oil prices balanced. They haven't been acting in that balanced manner, but we mentioned this at the beginning of the discussion. If gasoline prices go up, people still buy. They have to buy. It's, basic tenet of their work, their life, their businesses. If you could see the massive price spike we saw where gas prices doubled in the US, that resulted in a 5% decline in gas consumption. Wow. Think of how crazy that elasticity is. Right. So on the flip side, you have to see the economy crater. You'd have to see disaster for people to say, I'm not driving anymore. I'm going to keep the temperature low at my home, or I'm going to turn off the AC. That has to be a really terrible experience. So if you're saying right, and I'm not quite apocalyptic, but right, if you look at the 2008 recession, people kind of forget about this because it's forever ago. But it took until halfway through 2008 before gas prices started falling, and then they started falling off a cliff because it was okay, everyone's losing their jobs. This is a disaster. This is historic economic collapse. But when it was still looking like this is probably just a little slowdown, this is a minor recession, gas prices weren't responding. Yeah. I think you would see a similar thing here, with a caveat that with dynamics in natural gas prices are really more about how much can the US export. And the same thing for electricity, because a lot of electricity in the US is natural gas based. It's how Europe needs natural gas because they're cut off from Russia. How much can the US export? Right now, the US is limited by capacity. More capacity is coming online in the next 2 or 3 years. I think people in the natural gas sector talk about we're big increases in production to try to meet this demand from Europe. But you could plausibly see if this is an extended thing, a structural shift where gas prices are more expensive in Europe and the US exports a ton more to Europe. And that would be a level shift more than just a temporary, hey, we're supporting for a year while the Russian gas is turned off. If it's turned off for a decade, you're supporting for a decade.
Right. Well, I do think that there's a lot of opportunity around the build out of infrastructure, because our gas reserves and our ability to process it, liquefy it, and export it to the rest of the world are really a competitive advantage for the US that is not likely to go away overnight. If you look at the electricity rates we pay here relative to Europe, it's double the price over there that it is here. In Japan, it could be up to 3 times the price. So I think if you are in any way exposed, there's going to be a big opportunity to capitalize on this trend of building out the infrastructure to continue to export energy as we essentially take market share away from Russia in the long term, right?
Yeah, and I think that's like the bull case, but it's the same thing here, where it's like a lot of uncertainty. And I think there's actually a broad trend that's worth talking about, where it's like, this is me stepping out of like, I'm taking off the data-driven hat, I'm putting on like the theoretical hat here. It's like, okay, if countries are really worried about geopolitical risk, that's like a thing that we've seen grow over the last 3 or so years, especially. What they want is production to be within their borders, within a country that they can trust or are friends with, or is their own domestic country. That requires a lot more investment. And so, I'm again on the theory driven hat. If you think this is a structural long-term trend, people want, are going to want more domestic security for decades. That could be bullish for all this capital investment that's necessary for that.
Yeah, I fully agree. We've got about 10 minutes left. I want to make sure we touch on a few other input costs. So I'm going to kind of put a broad statement out there. I think a lot of our distribution community is going to be interested in your views on metals, but also we can talk about labor, equipment, trucking and freight we already touched on. What are your kind of consensus opinions, and where do you see perhaps yourself disagreeing with what some of the consensus opinions are in terms of any of those commodities and input prices as we look out to the rest of this year into 2023 and then beyond that as well?
Yeah, I would say the term I've put this in for base metals and for oil is like, China is exporting deflation or exporting disinflation, however we're going to phrase that. The domestic choices they're making are pulling down a lot of commodity prices in the US. And if you're looking at base metals, what you're really looking at in a lot of ways is the Chinese housing market and Chinese infrastructure investment. And that has been like, that's the real crater, where we're talking about how bad the US housing market is when we've seen like a 25% drop in housing starts. The Chinese housing market is seeing like a 50 to 60% drop in total housing starts, inclusive of multifamily, which is a much bigger deal there. So that's like, crazy driver. And I think that's really the big reason that you're seeing, aluminum and zinc, to a lesser extent steel, dropping in price so significantly, is mostly from that demand effect. It's hard to gauge how sustainable that is. I think people have kind of been saying for like more than a year at this point, like, are they going to keep letting the housing market drop? Are they going to keep pursuing COVID zero? And I think at one level, like, nobody really knows that except maybe Xi Jinping, and I don't know if he really knows. But like, that's the key driver in my mind, is this like collapse in demand there. That's what I would be worried about. And you also have like, in the US, demand softening, definitely not to the same degree, but it's maybe less fragile than energy markets. Like, it's maybe a more permanent decline, but we've also seen, like, everybody's been paying attention to, like, at once a week you'll see one random metal that's like up 10%. You're like, why did this happen? So yeah, the similar thing where markets are definitely really on edge, and prices vary a lot. On labor, because I think that's like the big thing that I enjoy talking about. I think that's the one thing where you can very easily point to and say, this is the thing the Federal Reserve controls demand for. They control aggregate demand for labor. Through aggregate demand for labor, they control consumer demand, and that passes through to inflation. The frustrating part for them is, like, if there's 9% inflation, plausibly like 3 or 4% of it is supply chain stuff, gas, oil, food, things that they can't control. And then maybe there's like another 3% that's like labor driven or like core services driven from demand that they can't control. And then you have like the 2% that they're actually aiming for. And so they kind of need this like immaculate disinflation. On the same time, they have this weird moment where they want to pull labor cost growth down without making it too bad. I think the data we've seen over the last few months, it's really early to tell, really early. Cannot stress how early it is. But I think it's consistent with this idea that like some people are re-entering the workforce, who left during the pandemic, maybe parents with small kids or like older people who retired or students who are just like, yeah, it's not my time right now, are entering the workforce more. You have that labor supply improving and employment growth at the same time that like wage growth is slowing a bit. That would be like the ideal case for them. I think the people at the Federal Reserve expect to have to do more. They expect to have to push harder to get wage growth back to like what they see as an appropriate level. But like the ideal case where they don't have to push that hard, they don't have to like increase unemployment to get prices back down is like plausible still.
That's encouraging. I mean, it's important to highlight the difference between slowing wage growth and wage declines, right? Because once you give someone a raise, you can take that money
doesn't go back.
It doesn't go back. And so as I think about the implications of what you just said to planning from a cost basis on the part of distributors and the part of manufacturers, they're going to be facing, for at least from the labor component, more pressure on the bottom line, right? It's going to be more and more expensive for them to maintain their existing workforce. It's very competitive to attract new people into their organization. So that's going to keep the pressure on. It sounds like there may be some offset in some of the other input prices that we were talking about, but to your point with the Chinese housing collapse and the effect that that has on, I'm sure, steel, to an extent, aluminum, copper, obviously very prevalent in its use in the commodity markets. That also has the potential to see some upside pressure. Let's say if they say next year we're going to open things up a little bit and allow the housing market to rebound some. So what does that mean in terms of price moves moving forward? I mean, it seems like if I'm a distributor, I'm looking at increasing costs in labor. I'm looking at flat to potentially increasing costs on the material side, right? That probably means that I've got to figure out a way how to have a conversation with my clients about ongoing price increases. Now, they might not be as painful as what we went through in 2021 and so far in 2022, but it's still going to be a part of the conversation, don't you think?
Yeah, and I would say that's pretty consistent with like what the data we have. One of my favorite tools is something the Atlanta Fed does, where they survey businesses about like, hey, what do you expect your unit cost growth to be over the next year? And recently we've seen like the first declines in that. Normally businesses forecast about 2%, unit cost growth, that's 2% inflation. That's the target. That's the goal. They were forecasting, almost 4%. Now it's back down to like 3.75. And so on the one hand, you're like, well, 3.75 it's going in the right direction that they want. While on the other hand, 3.75 is a lot bigger than what it would be pre-pandemic. And that's still, rising costs. And the problem, I think, for the Fed, if you have this immaculate disinflation, like, hey, supply chains improve, all this stuff improves without us having to crush demand, that still wouldn't get inflation back down to target. And the other problem with that is like they want to balance, they want to have a strong labor market, they want to have a strong economy, and they need to get prices down. They really need to get prices down. So at the same time, where they're not in like a we will break everything mood, they're committed to getting prices back down. And if there are costs associated with doing that, they are willing to pay those costs.
And they're so willing for the American people to pay the costs too, as Jerome Powell alluded to, right?
Right. So if you look at their forecasts for like they're going to release new forecast, I think, next month. Their forecast for unemployment over the next year or so was for it to go up. Their forecast for GDP growth was for it to decline. They expected the economy to have to slow, the real economy, and have to slow in order for prices to get back down. And I think if we were talking in July, I would have said, hey, a lot of this immaculate stuff is working its way out. It seems like they're a little more worried about a recession. It seems like they see the economy slowing in a way that they agree with, and now they're worried that it might slow too much. We're looking at it now, and it's very funny because they got the immaculate disinflation. They got gas prices down. They got a little bit of food prices. They got these industrial metals. But what that means is they got to push even harder. If the economy is doing well, they got to raise interest rates more. It's like good news is bad news kind of dynamic. Whereas like gas prices are down, that means economic growth is going to be less constrained by energy, but that means economic growth is going to be higher, which might mean price growth is higher. So we actually have to raise rates a little more. So that's what the dynamic you've seen over like the last month. And so I'm saying we're not out of the woods yet.
And on that note, I just wanted to say this has been fascinating. Hearing you pull together all of these data points and build the narrative has been really informative for me. Any last closing thoughts based on everything that you're seeing around? And if you're going to give distributors a bit of advice based on the economic landscape for 2023, what would you say to them?
You know what? I would say the best advice that I can give anyone here is that the only people who have been right have been the people willing to admit that they were wrong. And it's been a really messy 2 years or 3 years, I'm certain, for everybody. And so the best thing you could probably do is try to stay nimble and try to question, the assumptions, the plans, the decisions that you're making, because that's the way that you continually improve. It's very generic advice, I know, but I think it's something that can easily be forgotten. And question the things we're saying here too.
Well, yeah, and I think the key idea is you have to keep up with the data. You have to allow yourself to have a business plan that incorporates all of the latest readings on the economy, and without making a huge 90-degree turn, you kind of steer the ship a little bit based on what you're seeing on the ground. And essentially, in essence, that means be a data-driven decision maker, which is great advice to end the subject with. So again, Joseph, thank you so much. It's been a pleasure having you on the show. I really got a lot out of our conversation. I hope our distributors did as well. I'm going to put up my presentation once again here, and we're going to talk quickly about the next 2 webinars coming up. You can see on September 14th, the next episode of the Wholesale Change Show. September 21st, we've got Frank Hurdy from River Heights Consulting talking about competing and winning with value-added services. My name is Alex Chausovsky. I'm here on behalf of distribution, the Discerning Distributor. Joseph Politano, you can see here his contact information. Check out his newsletter. It's really high quality stuff. I highly recommend it. And again, be that data-driven decision maker as you look out to the rest of this year and to 2023. Joseph, thank you so much for joining us. And everybody, have a terrific day. Take care.
Take care. Thanks for having me.
Absolutely. Bye-bye.